This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Welcome to episode 16 of the Rational Reminder Podcast. We are back in Ottawa. Cameron and I, we're back in Ottawa after spending most of last week in Chicago for the Dimensional Fund Advisors Advanced Conference 2018. We did record an episode from Chicago with PWL's president, Brenda Bartlett. The audio wasn't great for that episode, so if you did listen to it, sorry about the sound quality, but we decided to publish it anyway because I guess we had some good energy from being at the conference, and we thought it was a good discussion.
And we learned something about podcasting.
We learned something about podcasting outside of our little studio that we have here. So the other thing that happened last week while we were away was that the market was pretty volatile. It took a bit of a... What day of the week was it that it took most of that dip?
Thursday was the bad day, I think.
Yeah, so Thursday.
Wednesday, Thursday was down 1,300 points or so on the Dow. And it's funny, I look back over the years I've been going to that conference, and it seems that has happened. This is anecdotal, of course, but that has happened often in the past where we're sitting at this conference watching and waiting for people like Professor Fama to give his feedback on what's really going on in the markets.
Now, remember you talked about a couple of episodes ago how October's not really that bad historically?
No, I know. That's the data. That's why it's anecdotally.
And here we are. So last week, the Russell 3000, the U.S. market index, was down 4.22% for the week. So I looked at all of the weekly returns going back to January 2010 for the Russell 3000 just to see how bad that actually was in the recent history. And it was the 13th worst week going back to January 2010. So out of 458 weeks, it was the 13th worst, which is, I don't know, kind of bad, I guess.
Kind of bad, but I was looking at a chart this morning, and I think the S&P 500 is back to where we were sometime mid-July.
I believe that.
More or less.
I believe that.
And I think we're up still for the year, 5% on the S&P. So a little bit of context. And I know Michael Batnick and did that YouTube video last week with Reform Broker, and they were talking about how, some of these big stocks, some of the FANG stocks have had huge drops, but it kind of brings them back to where they were only a few months ago, and they're still up like 50% or 70% for the year. Yeah,
unless you just bought.
Well, yeah, of course, if you just bought, you're not happy being down 25, 30, or 35%.
Yeah. MSCI EAFE, so International Plus Emerging Markets, it had its 22nd worst week of the last 458, so again, not that spectacular. And the Canadian index had its 23rd worst week out of 458 weeks. So yet again, nothing to see here, really.
So how many concerned emails and phone calls did you get last week?
Concerned, not a single one. I got one email from a client saying basically like, yep, volatility, I'm ready for it. Just a reaffirmation of their own non-concern, I guess.
I've had a few people comment that their portfolios, because let's face it, a 60-40 portfolio so far this year has not had a great year.
It's down 2% or something.
Down
right?
A little bit. It was up 1% or 2% a few weeks ago. So it's in that range of kind of flattish. And a couple people were wondering, like, what's going on and should we change our strategy? I would imagine their views have changed perhaps a bit with last week's drop.
I got that question once, actually. Yeah, I did. And this is not from last week, but just for this year, I have had the question of, do we need to make any changes?
But people know the portfolios are all being rebalanced automatically. And this is the beauty of this philosophy, is that it's automatically based on the price of things, picking up different parts of the market, different asset classes that may be cheaper. So it's not like we're just closing our eyes and hoping things will be okay. Stuff is happening all the time inside the portfolios.
And it's maybe tough for investors to see too, because we're in this kind of funny market where interest rates have been rising because the economy is very good, but stock markets haven't been that good. So you get rising rates, which is causing bond returns to be negative or low, while stocks are also not great, despite good economic data. So it is kind of a funny market so far this year, but obviously can't predict what's going to happen next. So you just maintain the asset allocation that's right for you all the time and rebalance.
And if you look at the potential outcomes, the expected returns, this is not abnormal, historically speaking.
No. I've had a couple of interesting emails where people have said things like, we were trying to decide between paying off some debt or adding some cash that we have to the portfolio.
Yep.
And because markets have been bad, we're going to pay off the debt. Yeah.
That's kind of backwards.
It's backwards. So I explained that when I had those interactions, that, you know, when markets have gone down or markets are volatile, that's when your expected return is higher. So that's actually a better time to invest. But in both cases, I said paying off debt makes more sense anyway, as we've been discussing for the last little while, paying off debt.
So I think we both highlighted a tweet from Paul Krugman.
Yeah.
Who's a Nobel Prize winning economist.
Well, I think around the time markets start to get volatile, like they were last week, a lot of people people are doing this all the time, but especially in periods of volatility, people start coming out and saying, this is what's happening and this is what you should do. And Krugman had an awesome tweet. So he's a Nobel Prize winning economist, so maybe his opinion is worth something. But he said, for inquiring minds, why did the market suddenly plunge? I have no idea. Will it keep going down or bounce back? I have no idea. Is this going to translate into problems for the real economy? I have no idea. But what you need to know is nobody else has any idea either, which I do think is extremely important, because wherever I feel like it's especially bad in Canada. Like in the US, you have guys like Josh Brown, who's actually on television. Like he's on there talking about things that are rational. In Canada, at least when I look, if you look at Globe, Toronto Star, Financial Post, it's all prediction-based, active stuff.
Right.
Like you're not going to go to any of those Canadian, but well, Globe and Mail maybe a little bit with guys like Rob Carrick. Money Sense is pretty good, obviously, with Dan. But a lot of the big financial publications in Canada, it's all prediction-based stuff.
And that fuels the fear where you think you have to do something. Because when the market does fall like that, it is scary. So that fear hits your brain and you want to do something to take that fear away. It's human nature.
Yeah. And even if someone did know exactly what was going on in the economy, if someone is able to say, you know, it's this thing that is causing volatility to happen, that person still doesn't know how the market's going to be tomorrow. And nobody does know that. Nobody has that perfect economic insight. But if somebody did, it still doesn't mean they can predict what's going to happen, how the market's going to react to that information. Fama talked about this sort of in a way when we saw him speak last week. But he reminded the room that prices move due to changes in expected earnings, so how the market perceives the expectation for future earnings.
Which is the fundamental stuff.
Right, fundamentals, and investors' appetite to pay for them. So if your discount rate goes up because you see the market is riskier, that discounts the price of stocks lower. So it's those two things that really are what affect stock prices. So if we see a plunge, it could mean, well, I guess one of two things from Fama's perspective. The market believes future earnings are going to be low, which maybe seems unlikely based on the economic data that's been coming out this year. It's been very strong. Or the market is saying, well, these future cash flows are now riskier for whatever reason. So maybe that's what's happening. Maybe the market is pricing in.
Or people just start getting scared.
Which is the risk, right?
Blindly.
That's their
appetite for risk may change.
That's the discount rate increasing. Whether they believe they're selling blindly or not, if they're selling, it's because their discount rate has gone up.
But I think a lot of people are getting smarter. Perhaps you're right in the U.S., given the appetite for index funds in the U.S. But if you've gone the index route, you've kind of self-selected yourself. You're in this efficient market belief structure. Although a lot of them I know are actively traded, but I think more and more people are getting it.
Maybe. But there's other stuff too. Like we think about how much money is institutional versus retail, and you think about all the money that's still in active mutual funds in Canada. Like that's still the vast majority of Canadian fund assets. And you think about the mutual fund managers. Like put yourselves in one of their shoes. They've got massive career risk. I was listening to Howard Marks on a podcast recently. He's got a new book out, I guess, doing the podcast.
There's a lot of different podcasts now.
An interesting guy to listen to. He is continuing to be a very successful investor in distressed debt. So he's had a fantastic career in terms of his returns. Who knows if that's luck or skill? Obviously, a different conversation. Don't let him hear me say that. I wouldn't want to debate with him whether he's been lucky or skilled.
But he talks about trends, right? He's a big trend follower.
He's a big trend follower. But the thing I wanted to mention is that he talks about Warren Buffett. And he says in his book, one of the things he talks about is why Buffett has been so successful. I think it was in his book. But he says that one of the reasons Buffett's been so successful is because he doesn't work for anyone. So he can take bets. He can do stuff that other people might not think is a good idea. But you think about active mutual fund managers where there's a ton of money invested and they have to do stuff. They have to be doing stuff, and they have to be doing stuff that their investors will see as potentially a good decision.
Because you have to be different.
Have to be different from the market, but you don't want to be too different from the other active managers
Right.
and be wrong.
But it's such a fiercely competitive market, you have to be different.
You have to try to be different. Then
Yeah.
we get into the discussion of closet indexers, which aren't different, but they're still charging active fees. That's a whole other topic. I mentioned strong economic data out of the U.S. I was looking at a report from FactSet on Q3 earnings, and they called it blended earnings. So I guess it's a combination of estimates from companies that haven't released yet and the actual earnings of companies that have released. But they said the earnings of S&P 500 companies have increased 17% so far this year. So a huge increase in actual earnings. So that's actual economic data. Companies are doing well. And they also talked about how profit margins are very high and have been increasing, which is potentially due to the big companies like Apple and Amazon, which we know to be Amazon's not super profitable, right? They've got tight margins.
Yeah, I think pretty tight margins.
Yeah.
But anecdotally, I mean, Chicago was booming last week. Maybe it was, I was there on the weekend, the weather was good, but the restaurants, and these are pretty nice restaurants, are jammed. Every place we went was
I noticed
jammed.
that too.
And the prices in restaurants are unbelievable.
Everyone's wearing a suit too.
Everyone looks good. They're eating fancy food. It was quite something to see. Now, maybe we're in a little bubble there, perhaps, but boy, they're sure spending the money.
You told me a story on the opposite side of anecdotes about in 08 when I guess we had one client who pulled his money, and it was after a trip to the U.S. Do you remember that story?
I'm racking my brain. No, I don't.
You told me a story that it was a client who was visiting. I don't remember what city in the U.S., but they were walking down the street and it was just vacant. All of the buildings were vacant, and they called you and said they wanted to go to cash.
There's a number of people like that, a number of stories like that, so
okay.
Not surprising.
Yeah. So when things are really good, obviously then people start to get concerned of, are we at a top? Earnings are so strong. Returns haven't been that strong. What does that mean for the future? And obviously we have no idea, really. But historically, we can look at when the S&P 500 has reached peak earnings, because obviously we know in hindsight when that was.
But even think back to when the election was on in the U.S. Go find me someone, if you had told them that you knew Trump was going to win, that they would want to buy stocks.
Oh, there are people that wanted to pull out.
That's my point. I mean, that was a long shot prediction at best. Even after you knew that, people are not in a rush to buy. I mean, who would have thought this could turn out like this economically?
Yeah, and a lot of that growth, I think, is due to the tax cuts. Not all of it, but I think some of it, like that, is helping the U.S. economy. Obviously, there are other implications of that, but whatever. We're not talking about that right now. So about 75% of bear markets in the U.S. have occurred during economic recessions, which obviously we're not in right now with earnings where they are. And returns have remained positive until about 6 months before the recession. So, I mean, I guess it's just another way of saying that you can't time the market.
Right.
And trying to, that's that Peter Lynch quote. I'm gonna mess it up, but something along the lines of more money's been lost trying to prepare for corrections than been lost in corrections themselves.
And speaking on the prediction front, so we had a listener sent in an article this week and wanted us to chat about it. So it's an article that was in Forbes magazine written by John Malden. The title was, "With this extent of passive investing, even a minor correction will be disastrous." So John Malden is, some people would call him a perma-bear. And the basic premise of the article is that because so many people are buying the indexes, that when they start to fall, people just blindly sell. And since they didn't do any research at all going in, they're going to do no research on the way out and just want to get out at any price. We both read the article. It's loaded with statements that are very opinion charged as opposed to fact-based.
What were your favorites?
So some of the ones I liked. So things like passive investing is taking market distortions to new extremes. Or here's another one. We've created this environment in which badly managed companies can still see their stock prices rise along with those of well-managed companies. Another one. In this environment, even a minor correction may be disastrous for stocks.
Yep. Lots of opinion and hyperbole. I agree.
But it's just loaded with opinion that certainly encourages people to take action.
Well, you think about what he's basically saying with those comments. He's basically saying that because of index funds, market prices are wrong because they're forced to buy a large amount of the largest stocks, which means that the prices are pushed up artificially, even if they shouldn't be, even if that's not justified. So, I mean, it's the classic story of index funds affecting price discovery, which has been debunked on multiple levels. But
I mean, we talked about that a few weeks ago. It's a very small part of overall trading. It's still the active manager setting price. You can make the argument it's the index funds providing liquidity of shares to active managers who want them.
So one of my favorite charts that I've seen recently is Vanguard had a chart out showing that index funds make up about 1.3% of annual trading volume. So yes, index funds are growing in terms of assets under management, but in terms of actual trading that is going on, and keeping in mind that trading is what sets prices, that is the mechanism that allows prices to be set on the market, in a liquid market. And 1.3% of that trading is done by index funds.
Crazy.
So even if index funds are blindly buying and they have no idea what they're doing, which I guess is true, they're not the ones trading. So it doesn't matter.
Most passive investors, if you go by the definition of passive, are largely accumulating, so they buy and hold.
Sure. The other thing we have to remember is that anyone investing in an index fund is not necessarily a passive investor.
For sure.
Like I'm sure, I don't have the data on it, but I'm sure there are tons and tons of people who are actively trading ETFs, which again, even if indexing was a larger percentage of trading, which it's not, but let's say it was 80% of trading or something like that, you still have people using ETFs actively, which is still participating in price.
And even when you buy an index ETF, I mean, this is the point of the article. You buy an index ETF, they have to go and create this ETF by picking up the shares in the market. So there's a seller on the other side. So there's price discovery there as well. Someone's willing to let them go at that price.
Yeah, there's somebody on the other side of every trade. Yeah, always important things to remember.
I got a kick. I did a quick Google search this morning to see, well, what other predictions has he made? So there's one going back to February of...
This is from the same author?
Same author.
Okay.
So the same John Malden made this prediction back February 2009, which in hindsight may have been the best buying opportunity of certainly my lifetime. But here's the prediction. Let me reiterate my continued warning. This is not a market you want to buy and hold from today's level. This is just far too precarious an economic and earnings environment, which may be legitimate opinion at that point, but you look back, we've had the best decade since then.
Yeah.
Unbelievable.
Yeah. You can have very well-informed, intelligent opinions on what's going on in the world. It's kind of what we were talking about earlier in this episode. No matter how smart you are and how well you understand what's happening, it means very little for what's going to happen in financial markets and your ability to predict financial markets. I mean, I've seen studies on, I wish I had the data in front of me, but I've seen studies on the ability of economists to predict even the economy, and it's horrible.
Right. Like
worse than flipping a coin. Listening to an economist is worse than flipping a coin in terms of what's going to happen in the future.
But it's because you don't know how other market participants are going to react to the information.
Right.
Look at the example, the pencil example we had last week.
Yeah.
You take this, who was it Samuelson gave that presentation? Or was it Miller?
No. I don't remember who it was.
Anyways, we can clarify for next week, but it's a presentation made by one of the
Friedman?
academics.
Was it Friedman? Or was it Samuelson? I think it was Samuelson.
I mean, it's a video that goes back.
It's a great video.
30, 40, 50 years perhaps. And basically said to make a pencil, it takes so many different people from around the world to, mine that's not lead, but to grow the wood, harvest the wood, make the paint, stamp the letters, get the rubber for the eraser, and to come together. So you have all these market participants that come together to make a simple pencil. You take that to every other product around the world. It takes us so much energy and efficiency to pull that off.
But he talks about how the shared idea of capitalism is what allows that to happen. I mean, he takes it to an extreme and says that capitalism is what, I can't remember the words he used, but it's like the mechanism of peace and harmony around the world. Kind of a funny thing to hear, but it's true.
Enabled a pencil.
I'm reading this book called Sapiens, which is it's like a brief history of humankind, of Homo sapiens. And it talks a lot about that, about these shared ideas that humans have, like it's been in the past, things like religion and belief in different deities and things like that, that's allowed Homo sapiens to organize in large numbers, which we're the first species that can do that. There have been species that can organize in small numbers, And even like the Neanderthals were able to organize in small numbers, but Homo sapiens is the first species that's able to organize in extremely large numbers based on a shared belief. When the author talks about it as being these imagined things, religion being one. That's not my opinion. It's the author's opinion. Religion being one of these imagined things. But he also talks about how capitalism and belief in capitalism is, I mean, it's the fabric of our societies. It's how our whole culture is built around capitalism. And in the pencil video, he's absolutely right. It is true that the world is able to cooperate and work together peacefully based on a shared belief in capitalism. Anyway.
Especially when you look at the products that make that pencil come from different countries, different environments, different regulations, cultures. Different cultures.
Yeah.
Good example.
Everyone organizes around capitalism. Really is amazing stuff.
So what else did you take out of Chicago?
So we talked a little bit about Marlena Lee in our last episode. She's the co-head of research at Dimensional. She's very impressive. So she did her MBA. I don't know if she finished her PhD yet.
I don't know, but she was Fama's TA, right, at one point?
Yeah. But I think she said that she did the same thing as David Booth, where she was studying under Fama and told him, I think she said, I don't know if she finished her PhD, because I think she told me that she decided not to finish it and told Fama that, and so he hooked her up with Dimensional. And obviously, I mean, she must have been one of his top student for him to do that. But she's very impressive and very relatable. Like when we had dinner, I guess I didn't really know what to expect, but she was just a regular person, I guess, as everybody is. But she was just able to carry on a regular conversation about kids and family and stuff like that. But then as soon as you flip the switch to asking a question about capital markets or portfolio management, it's like...
She's the real deal.
Yeah, it's like the Incredible Hulk.
And then 80 researchers, right, in that group? Largely PhDs, I believe?
It wasn't largely. There were, I can't remember what the number was, 20 PhDs or something like that.
From all kinds of different backgrounds too, right?
All different disciplines.
Rocket science, engineering, mathematics, economics, finance.
It sounds like a fascinating place to be. I mean, even just being around all the Dimensional people, they're all, even the guy that gave us the talk on the history of the University of Chicago, like he's a Stanford graduate. They're all super impressive people.
Yeah.
Anyway, bit of a digression there. So Marlena Lee spoke to the group for 2 full hours on Friday. And lots of good takeaways there. To be honest, it was a lot of stuff that we've maybe heard before, just because Marlena published a lot of papers, and when you read the papers, you pick up the kind of talking points that she has. But interesting to hear her speak nonetheless. One of the things that she talked about, which we've known for a long time to be one of the big benefits of Dimensional, is that index funds, when you're tracking a third-party index, the index reconstitutes. Depending on the index, it may reconstitute quarterly or sometimes it's annually. But as soon as an index reconstitutes, the index funds have to match the index because their job is to reduce tracking error. So what happens is the index provider announces reconstitution, shows the reconstitution list or the new index, the reconstituted index.
And the weightings.
And then the next day, all the funds have to trade. And so you get prices being pushed up as everyone's buying the same securities. And then on the other side, prices being pushed down as everyone's kicking their securities out of the portfolio.
But their mandate is to match.
They've got to match the index.
Zero tracking error, it's called. They have to track the underlying index set by Russell or S&P or who be it.
And I don't remember the Dimensional. I've seen the data point in the past where they've estimated the cost of reconstitution from index funds that have to track an index. And I don't remember what the data point was, but it's
meaningful.
It was a meaningful amount. Yeah. So having that reiterated was interesting. And then same thing for active funds, obviously. Even more extreme though, if the analyst says we need to buy this company and the portfolio manager says, okay, we need to put $1 million into this stock right now. It's the same thing, but more extreme, where you're going to move the price. But if the stock is trading at $10 and the analyst is saying it's worth $15, you don't care if you push the price up a couple bucks,
right? Because
you're still getting, in your eyes, a great deal.
Yeah. I was quite taken by the amount of data that is actually going through. Like I think we had the presentation this summer from Apollo talking about how it's the largest set of data in the world. I believe that's what he said.
Yeah.
Every night, they said they upload 1,500 data points for over 15,000 securities around the world. Yeah. So it's 22 million data points a night come into their system for analysis. And the research group does what they do on this data, but also reviewing other published, peer-reviewed papers to come up with the strategies that the frontline portfolio managers will use.
And corporate finance announcements, like they're not just taking the raw data, they're taking the data and then they've got an overlay where if something's happened, like an announcement of a merger or an acquisition that would affect the straight hard data metrics, then they're taking that into account before they make any portfolio decisions. Everything that they're doing is to minimize trading while maximizing exposure to the factors of higher expected returns.
Right. So some companies post different types of expenses differently.
Well, they talked about
the balance sheet items differently, and so they have to go and re-enter them under the proper format given the papers that they will have followed.
Yeah, I think they had
to make the data better.
It's if a company discloses an extra, a non-recurring expense on their income statement. If they disclose the same non-recurring expense multiple times,
that was it.
Then Dimension will say, well, hey, this is not a non-recurring expense, and then they'll take that into account when they're determining. I guess that would be for profitability.
It's all about making better data.
Yeah. No, that was really interesting stuff. They also talked about the interaction between different factors. So, for example, if you decided that you were going to target only high profitability stocks, then you end up with a large cap portfolio because the large cap stocks tend to be the most profitable. Obviously, we know that small cap stocks have higher expected returns than large cap stocks. So if you only focus on one factor at a time, you end up with these wacky portfolios that actually lower your expected returns. So they talked a lot about, and Marlena talked a lot about how they manage the different factors together to target the higher expected returns without ending up with some wacky result. So I guess there is, to some extent, some subjective overlay just to determine how much small do we want versus how much profitability are we willing to give up.
Yeah, subjective and sensible, and that kind of goes back to what Fama was saying about different risks that science won't necessarily pick up, right? On the Thursday session we talked about last week. So it's kind of the cross section of science and robustness in the portfolios.
It's worth revisiting. I know we talked about it in the last episode, but maybe not everybody heard it. When Fama was asked about risk over long periods of time, and he laughed and said, yeah, you've got a lower probability of a negative outcome, but the magnitude of those negative outcomes gets larger over time. So yes, you've got a lower probability of having a negative outcome, but if you end up with a negative outcome, it's bigger. It's bigger over longer periods of time, which is what you'd expect with compounding. But anyway, one of the last things that I wanted to chat about today was Marlena talked about other firms that are doing just sort of somewhat similar research to Dimensional. And there are two main competitors who we don't hear too much from in Canada just because I don't think AQR has a presence at all.
No.
And RAFI, so that's the research affiliates who has the fundamental indexing. They do have some Canadian products, but they're not big. Like I've never once heard about them other than me doing my own research, but no client has ever asked about RAFI. So anyway, Marlena talked about the other firms that are doing different types of research and coming to different conclusions. And you think about like RAFI, their fundamental indexing strategy is based on the principle that markets are not efficient. So they use what are called economic factors, so stuff like sales or number of employees, where they're basically trying to find undervalued companies. But Marlena showed regressions for both RAFI and also for some other products. Actually, I don't think she named the indexes, but anyway, she showed they just called it fundamental indexing. But they talked about all these different strategies that end up being just a repackaging of the factors that we already know about. And I wrote a post about this a few weeks ago. With RAFI, for example, you end up with a value, maybe a profitability tilt. But the problem is, and Marlena showed this, if you look at different time periods, so you chunk out 4 years or whatever it is, you don't get consistent exposure to the factors, which is what you'd expect because you're not targeting them. You're targeting something else. So what I called it in my blog post was naive factor exposure. But then the question Marlena posed is like, if you're going to target factors by accident, why don't you just target them on purpose?
Exactly.
Doesn't make a whole lot of sense. AQR comes out with a ton of really good research, and it's the one of the firms where I read their stuff, and every now and then it makes me question I wonder if DFA's thought of that, or Dimensional. They don't like being called DFA. I wonder if Dimensional's thought of that. And as I learned from talking to Marlena, yes, they have thought of that, whatever it is. And Fama had some interesting comments about AQR as well, where someone asked her questions about AQR, and he laughed and said, they're all my students, right? Which is kind of funny. But Marlena talked about this too, where everyone's got access to the same data. Dimensional, AQR, RAFI, whoever it is, the data's there. They're third-party data providers. Everybody can pay to have access to them. And Fama's comment about these competitors like AQR and RAFI, he said 50% of business is marketing.
So they have to be different. You have to isolate yourself from someone like Dimensional.
No one's going to come into Dimensional's territory and just say, well, hey, we're going to implement small cap value strategies, because Dimensional's so good at that and they've been doing it for such a long time. So you have to do something different if you want to compete in the factor space. So then you get companies like RAFI who are taking a totally different approach, saying, well, we don't believe markets are efficient. Here's a different way to approach it. And you get companies like AQR who are still taking the efficient markets view, but they're I don't know what you'd call it. Marlena was very careful not to say that they're doing data mining, but they're taking the data to a different level, and maybe drawing some insights that Dimensional wouldn't agree with, and then putting that into products. I read an article. I haven't actually read the article. I read a headline about how AQR has really struggled this year, so I don't know, whatever that means. But anyway, the way Marlena, the analogy that she gave is that Dimensional is like a diet pill where, if it works, you're gonna get a pretty good outcome, but if it doesn't work, you're gonna be okay. And then she said more extreme strategies, like if you're doing a momentum strategy, which a lot of companies are promoting, momentum's been extremely volatile. There's no sensible explanation for it, so we don't know if it's going to continue. It's expensive to implement. So she compared that to a cancer drug, where if you take that and it doesn't work, you're actually going to be in trouble, unlike the diet pill where you're still going to be okay. So that was all interesting to hear their perspectives on other companies that are trying to do similar strategies. And I do want to mention one more thing about AQR. So they had one of the most interesting papers they've published that really made me think. I don't remember the name of the paper actually. It was HML, Devils in the HML Details or something like that. But AQR basically said that when Fama and French defined HML, which is high minus low, that's the academic definition of the value factor, Fama and French used lagged price and lagged book value. So they took the price and the book value from 6 months ago, and they used that data to form the value portfolio today. And then they did the research on that value portfolio. And in the AQR paper, they say that it doesn't make any sense to lag price. It makes sense to lag book because we don't always have up-to-date book value, but it doesn't make sense to lag price.
And book doesn't change as much either.
Sure. But it doesn't make sense to lag price because we have price. We have price every single day. And I was like, geez, that
seems sensible.
That makes a lot of sense. And AQR in the paper, they show that if you actually define value this way, you get way better results. So I'm like, man, I wonder if Dimensional's thought about that. So I asked Marlena about it, and her answer, it blew me away really. But she said, of course we know about that. But when you don't lag price, you end up with a momentum effect. So if you use current price to form a value portfolio today, you'll end up with momentum because stocks that I guess recently became value stocks are being added to the portfolio.
The price will have changed recently.
Right. So, okay, that makes a lot of sense. So in portfolios, what Dimensional does is they use the Fama French lagged price and book, but they take momentum into account elsewhere.
On the trading side, because the momentum is a short-term factor, I guess you could say, dimension.
So have they thought of it?
Whereas
yes.
the value is a longer term.
And not only have they thought of it, but they're implementing it in portfolios, and they have been for who knows how long.
And she knew the answer cold when you asked her.
Oh, yeah. I started describing the paper because someone asked a question about it to Fama, and he didn't really get it. So I started describing the paper because I didn't think Marlena had read it either. Because Fama hadn't. And she's like, oh, you're talking about this paper? Yes. Anyway, so the reason AQR got the better result was because they had the momentum effect built into their model naively.
Anyways, great conference. You were impressed.
I was impressed.
You were impressed.
Yeah. And market volatility, nothing to see here for now.
All right. We'll be back next week.
Yep, that's it.